Welcome to the Ultimate Beginner's Guide to Harmonic Patterns. In this free course, you're going to learn the theory behind harmonic patterns, how to trade them effectively, and a few details and peculiarities of such patterns, and their main advantages and disadvantages. Before we proceed, you should know that this video is made for educational purposes only. If you're new to the channel, please consider clicking the like button and subscribing right now, because this helps support the creation of free videos like this one. Without further ado, let's begin the course. In order to fully understand how harmonic patterns work and how to trade them effectively, there are a few prerequisites that we're going to quickly review right now. The main thing is to understand how Fibonacci ratios work, so let's quickly review them. If you already know how Fibonacci ratios work, you can jump to the video section where I begin to talk about the theory behind harmonic patterns. The Fibonacci ratios come from the Fibonacci sequence, which is very straightforward. The sequence starts with the number 0 and the number 1. To know the next number in the sequence, we always sum the last two numbers. For example, the third number in the sequence is the sum of the first and second numbers, which equals 1. The fourth number is the sum of the second and third numbers, which equals 2, and so on. That's all there is to the construction of the Fibonacci sequence. The Fibonacci ratios appear when we divide one number in the sequence by another number in the sequence. For example, if we look at the first four numbers in the sequence, we get the simplest Fibonacci ratios. For instance, 1 divided by 1 gives us 1, which is equivalent to the 100% ratio. If we divide 2 by 1, we get 2, which is equivalent to the 200% ratio. And if we divide 1 by 2, we get 0.5, which is equivalent to the 50% ratio. However, the most interesting thing about the Fibonacci sequence is that if we look at larger numbers and beyond, the ratios between two numbers are constant across the sequence. Let's take a look at larger numbers in the sequence. If we divide one number in the sequence by the previous number, we'll always get the famous golden ratio, which is 161.8%. If we divide one number in the sequence by the next number, we get 61.8%. We can also find ratios between numbers that are not adjacent to one another in the sequence. For instance, if we divide one number by another number 2 positions behind, we get the 261.8% ratio. If we divide one number by another number 2 positions in front, we get the 38.2% ratio. These are well-known Fibonacci ratios. Once again, the interesting thing about Fibonacci ratios is that they are constant across the whole sequence. For the study of harmonic patterns, you'll observe the most used ratios are 38.2%, 50%, 61.8%, 161.8%, 261.8%, and 361.8%. You'll also observe the ratios 78.6% and 127.2%, which are the square roots of 61.8 and 161.8%, and the ratios 88.6 and 113%, which are the fourth roots of 61.8% and 161.8%. The reason traders use the Fibonacci ratios is because such ratios can be found all around nature and culture, and the financial markets are not an exception. There is a certain mathematical harmony in the Fibonacci sequence that can be applied to many different places. The main way traders apply Fibonacci ratios in the financial markets is by measuring the ratios between different price movements in the vertical axis of the price chart, which is a way to calculate the size of one price movement in relation to another. For example, let's say that we have two consecutive price movements. Let's label the highs and lows as A, B, and C. The upward price movement is formed by the AB segment, and the downward price movement is formed by the BC segment. To measure the ratio between these two price movements, we divide the height of the BC segment by the height of the AB segment. Notice that we only care about the vertical axis. We are eliminating the time element of the horizontal axis. In this case, since they have the same size, the ratio between them is equal to 1, which is equivalent to 100%. That means that the BC segment is 100% the size of the AB segment. Let's consider another example. In this image, we can see that the BC segment is smaller than the AB segment. If we follow the formula of dividing BC by AB, we get a ratio lower than 100%. On the third and final example, if the BC segment is larger than the AB segment, we'll obtain a ratio that is larger than 100%. We display such ratios by connecting the beginning of the first price movement with the ending of the second price movement with a dashed line. That's the representation you will find in Harmonic Patterns cheat sheets. With that said, let's jump into the definition of harmonic patterns. Harmonic patterns are price action patterns where a sequence of price movements respect well-defined ranges of Fibonacci ratios. When consecutive price movements respect these ratios successfully, price enters what's called the price reversal zone, which is a zone where there is a higher probability of reversal due to the convergence of several Fibonacci ratios. Very much like candlestick patterns and chart patterns, we can divide harmonic patterns into bullish and bearish. The bullish patterns will point to a reversal to the upside, while the bearish patterns will point to a reversal to the downside. There are many different types of harmonic patterns like bats, butterflies, gartleys, cyphers, and sharks, so I will present each type and show the bullish and bearish variations of each one. After that, I will talk about how to trade such patterns and a few peculiarities of them. The first pattern we're going to study is called bat. Let's begin with the bullish variation, which will show a probable reversal to the upside. The bullish bat is formed by 4 price movements. This is the basic shape of the bullish bat. It's important that we label each price movement to facilitate things. We'll label all highs and lows as X, A, B, C, and D. You notice that most harmonic patterns will follow this order. The first step is to identify the first 2 legs of the pattern. The first leg is the price movement that goes from X to A, and the second leg is the price movement that goes from A to B. You notice that in harmonic patterns, price movements must respect a ratio or a range of ratios in order to work. In the bullish bat, the ratio between AB and XA must be between 38.2% and 50%. That's a rule. If the second leg is less than 38.2% or more than 50%, then we can already discard these 2 price movements as part of a bullish bat pattern. One way to quickly visualize this ratio is to connect the beginning of the first leg with the end of the second leg with a dashed line that shows the range of ratios that these 2 legs must follow. That's how you read a harmonic chart pattern cheat sheet. One important thing to notice here is that we don't care about the time distance between the beginning and ending points of the various legs in the pattern. We only care about the vertical ratio between the various price segments in each pattern. That's important to know for reasons that will become clearer later in the course. The very next step is to observe the ratio between the third and second legs of the pattern, which are the BC and AB segments. The ratio between BC and AB must be between 38.2 and 88.6%. If that condition is met, we can move on to the next step, which is to observe the ratio between CD and BC, which must be between 161.8% and 261.8%. As a final step, we must also observe the ratio between AD and XA. Notice that AD is the implicit price segment that connects high A with low D. Ideally, this ratio should be around 88.6%. That would produce the most harmonic pattern possible. And this harmonic proportion between the different legs is part of the power behind these patterns. The harmony of proportion begs for a reversal in a way. At least that's what the theory about harmonic patterns suggests. If all these conditions are met, there is a higher probability that price will reverse to the upside after the D point. In the bearish bat, which is the bearish variation of the bullish bat, we have the same exact set of proportions, but upside down. The ratio between AB and XA must be between 38.2 and 50%. The ratio between BC and AB must be between 38.2 and 88.6%. The ratio between CD and BC must be between 161.8 and 261.8%. And the ratio between AD and XA must fall at 88.6% ideally. All bullish and bearish harmonic patterns are mirror images of one another. So if you know the ratios of the bullish version, you automatically know the ratios of the bearish version. You just need to think about them upside down. The next pattern we're going to study is a modification of the bat, and is called alt bat. Let's begin with the bullish version first. Notice that there are a few differences between this pattern and the original bat. The ratio between AB and XA must be 38.2%. The ratio between BC and AB must be between 38.2 and 88.6%. The ratio between CD and BC must be between 200 and 361.8%. And the ratio between AD and XA must be 113% in an ideal scenario. Notice that the first ratio is stricter in relation to the bullish bet, and the third ratio can go all the way up to 361.8%. All harmonic patterns are similar, but these subtle differences in the ratios will alter the shape of the pattern since one ratio affects the other. In the bearish alt-bet, we have the mirror image of the bullish alt-bet. I'm not going to bore you by repeating the proportions again, but the main differences between the modified and original versions also remain constant in the bearish version. In the bullish butterfly, we have this shape. The ratio between AB and XA legs must be 78.6%. The ratio between BC and AB legs must be between 38.2 and 88.6%. The ratio between CD and BC must be between 161.8 and 224%, and the ratio between AD and XA must be between 127 and 141%. Naturally, we also have the bearish version of the butterfly, which is the exact mirror image of the bullish butterfly. Once again, pay attention to these subtle differences in ratios and ranges of ratios between the patterns, because this is what sets them apart. Next in line, we have the crab pattern. Let's see the bullish version first. In the bullish crab, the ratio between AB and XA must be between 38.2 and 61.8%. The ratio between the BC and AB legs must be between 38.2 and 88.6%. The ratio between CD and BC legs must be between 261.8 and 361.8%. The ratio between AD and XA must be 161.8%. In the bearish crab, we have the exact mirror image of the bullish crab. The same properties we observed in the bullish crab still hold true for the bearish version of the pattern. There is a variation of the crab pattern that is called deep crab. In the bullish deep crab, we have the following pattern. The ratio between AB and XA must be 88.6%. The ratio between BC and AB must be between 38.2 and 88.6%. The ratio between CD and BC must be between 200 and 361.8%, and the ratio between AD and XA must be 161.8%. In the bearish deep crab, we have the mirror image of the bullish deep crab with the same properties and peculiarities preserved. The next harmonic pattern we're going to study is the Gartley. Following the order used in the course so far, let's begin with the bullish version. In the bullish Gartley, the ratio between AB and XA legs must be 61.8%. The ratio between BC and AB must be between 38.2 and 88.6%. The ratio between CD and BC must be between 113 and 161.8%. And the ratio between AD and XA must be 78.6% ideally. In the bearish version of the Gartley, we have the exact mirror image of the bullish version. All ratios and properties preserved, but upside down. Next in line, we'll study the shark pattern, beginning with the bullish variation. In the bullish shark, we have a few peculiarities. There is no ratio rule for AB in relation to XA. The ratio between BC and AB must be 113 and 161.8%. The ratio between CD and BC must be between 161.8 and 224%. And the ratio between AD and XA must be between 88.6 and 113%. In the bearish shark pattern, we have the exact mirror image of the bullish version. The same properties and peculiarities remain constant, but they are inverted. Next, we are going to study a pattern called Cypher. Let's begin with the bullish version. In the bullish Cypher, the ratio between AB and XA must be between 38.2 and 61.8%. The ratio between BC and AB must be between 113 and 141%. The ratio between CD and BC must be between 127 and 200%. And the ratio between AD and XA must be 78.6 ideally. In the bearish Cypher, we have the same ranges and properties, but upside down. So the pattern looks like this. Notice that if you understand the bullish version of the pattern, you also understand its bearish version. Now we're going to move on to a slightly different pattern that has 5 legs instead of 4, like the patterns we have been observing so far. It's called 5-0 pattern. Let's begin by studying the bullish version first. The shape of the bullish 5-0 pattern looks like this. It's an expanding pivot formation, meaning a lower low followed by a higher high. The final leg of the pattern, the CD leg, is a price movement that returns near the demand zone created around B. If you don't know how supply and demand zones work, check out the Ultimate Beginner's Guide to Supply and Demand Trading in the YouTube card. The ratio between AB and XA must be between 113 and 161.8%. The ratio between BC and AB must be between 161.8 and 224%, and the ratio between CD and BC must be 50%. In the bearish 5-0 pattern, we have the exact same properties but upside down, just like we observed with all other harmonic patterns. Next, we are going to study a simple pattern called AB equals CD, which only has 3 legs. The bullish AB equals CD pattern looks like this. The ratio between BC and AB must be between 38.2 and 88.6. The ratio between CD and BC must be between 113 and 261.8%. The ideal here is that the AB and CD legs are roughly the same size, given the name of the pattern. In the bearish version of the AB equals CD pattern, we have the same proportions, but the pattern is upside down. Next in line, we have a pattern called 3 drives, which is composed by 5 legs. The bullish 3 drives looks like this. The logic of this pattern is that sellers will make 3 attempts to drive the market down, and then buyers will enter the scene. In this pattern, we only care about the ratios between drives X, B, and D, which must be between 127 and 161.8%. This sort of pattern will often appear when momentum indicators are showing false reversal divergence signals. In the 3rd drive, there is a slightly better chance that the market will actually reverse. As you might be expecting already, the bearish version is exactly the same as the bullish version, but upside down and preserving the same ratios and properties. This concludes the exposition of the harmonic patterns. Now we need to become aware of a few peculiarities of these patterns. One thing that is noteworthy is the fact that harmonic patterns are about ratios in the vertical axis of the price chart only. The time duration of each price leg is irrelevant for the pattern formation. That can sometimes distort the shape of these patterns in real charts. In the textbook version, it's assumed that all price movements have roughly the same time duration, but in reality, that might not happen. Let me show you a hypothetical example of that. Here we have a bullish bat pattern. The light orange boxes show the time duration of each leg of the pattern. If we change the time duration of each leg, we can get something like this, for example. This is still a bullish bat because it respects the ratios established in the vertical axis. The time duration of each leg is not important. So under the light of harmonic patterns, these two patterns are exactly the same thing even though they look quite different. Notice how the highs and lows of both patterns still align perfectly. The difference in the overall shape is coming from a time warp between the patterns. The conclusion here is that the same harmonic pattern can have an infinite number of different shapes. The key is to look for the vertical ratios only and ignore the different time durations between each leg of the pattern. Another thing you should pay attention to is that harmonic patterns don't tell you exactly where you should enter the market. They will simply tell you if price is currently respecting the optimal harmonic proportions of each pattern, which is something that will slightly increase your chances of success in a trade. As usual, you should combine this technique with other techniques in order to trade effectively. You might have noticed that some patterns have legs with ranges of optimal ratios and legs with specific ratios. It's difficult to find real patterns that will follow exact ratios, so it's important to work with a margin of error, especially when we talk about the 4th ratio, which is often specific, and the convergence of the 3 ratios that come before. Given these peculiarities, we can talk about how to trade harmonic patterns effectively. In order to trade these patterns, the trader must pay attention to the price reversal zone or the price reversal line. When we work with ranges of ratios, price will have a zone of probable reversal, and when we work with the exact ratios, price will have a line of probable reversal. Remember that if you work with a margin of error in exact ratios, you will have a tighter reversal zone instead of a reversal line. Once price enters the price reversal zone or hits the price reversal line, the trader must look for the confirmation from other trading techniques that are devoid of lag, like lines, supply and demand zones, candlestick patterns, and etc., in order to think about triggering a trade. The more techniques that are converging in the same point or area, the higher the chances of success in a trade. The third step is to establish a safe and logical stop-loss order. This is done case by case and according to the context of each trade. The rule is that the stop must be logical and not arbitrary. The fourth step is to establish a profit target between 3 to 5 times the size of the stop in order to assure a good risk-reward ratio. If you follow these rules, you will dramatically increase the chances of success in each trade. Let's move on to the conclusion about advantages and disadvantages of harmonic patterns. Let's begin with the advantages. The biggest advantage of this technique is that it doesn't have lag like other trading techniques, such as moving averages, for example. We are dealing with ratios in the vertical axis of the price chart, so the problem of lag is absent. This is perhaps one of the greatest qualities of a trading technique, and it's the one you should look for, even though it's not the only important attribute. As far as disadvantages go, the first thing that becomes evident when traders attempt to use this technique is that it can be difficult to see the harmonic patterns develop in real time if the trader is not used to them. The time warp issue and the fact that there are many different patterns can confuse traders who are not well versed in this technique. Beyond that, as I said previously, the harmonic patterns will not tell you exactly where to enter the market. They will only tell you if the current price action is within an optimal zone for reversal. This is why harmonic patterns should be combined with other non-lagging price action techniques like candlesticks and various types of lines if you want to have optimal results. One criticism that can be made regarding harmonic patterns is their underlying assumption that price action should fall within certain Fibonacci ratios. Even though we can observe Fibonacci ratios in nature, culture, and the markets, there is no scientific theory that claims such a thing. Harmonic patterns are merely the product of empirical evidence. We can indeed observe a bit of the self-fulfilling prophecy effect in such patterns, just like we can see in other famous trading techniques. The self-fulfilling prophecy effect is a flaw of many technical indicators and famous trading techniques, but it can be turned into an advantage if used properly. Certain indicators and techniques only work because too many people start to believe they work, not because they have a solid scientific basis that explains the behavior of price. If too many people start to believe nonsense in the markets will react to nonsense, and because of the self-fulfilling prophecy effect, nonsense will become true to a certain degree. That's it for this video. I hope you were able to learn a few things about harmonic patterns. If you wish to learn how to trade, please check out my paid courses in the video description. If you like what I do and wish to support this channel and the future creation of free videos like this, please click the like button, subscribe to the channel, activate the notifications button, share this video with your trading community, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.